And for a more in-depth look at China's real estate market, we're joined by Christopher Dillon. He's the principal at Dillon Communications. Christopher, thanks for joining us. Good to have you on the show.
My pleasure, Michelle.
So, Christopher, as we saw One reporting, we do have some encouraging signs. 20 of the 70 cities tracked by official data saw an increase in new home prices last month, the highest level in more than a year. Home prices rose by 0.06% in May from April. That doesn't sound like a big deal, but the important thing is that it is reversing the trend from the 0.1% decline that we saw in April. Christopher, do you think the market has reached a bottom?
That's a really good question. I think to understand that, though, you really have to understand the fact that it's not one market. It's a series of very, very different markets, even within a single city. I mean, you take a place like downtown prime real estate in a place like Shanghai versus some of the secondary and tertiary cities, they behave very, very differently. And no matter what, there's always going to be demand for that high-quality prime property in the Tier 1 cities.
Well, granted, you do have disparities against housing markets anywhere in the world, but we are seeing some signs of a recovery, and many say that has been the result of policymakers' work. The central bank has cut interest rates for the third time in 6 months. In May, the reserve ratio for banks has been lowered in order to spur more lending. What further action do you think Beijing will be taking?
Probably you're going to see more of the same. The thing to remember here is that all of the tools that Beijing has are fairly coarse and broad tools. So you're trying to turn around, to use an example, like the Queen Mary. It takes a long time for these policy tools to take effect, and it's a huge economy that you're dealing with, and also the development cycle also takes many years to do. So you're not going to see immediate effects from those changes. I think the thing to remember also, though, is there is huge demand, both from urbanizing people who are moving to the big cities and to the secondary and tertiary cities, and also people who want to trade up. Until recently, for example, a third of the households in China didn't have a private bathroom or a private kitchen. And as incomes rise and standards of living rise, people are going to want to live in better quality homes, and that's going to be one of the key drivers for the property market.
Okay, and are those the kind of developments that developers have built and that are standing waiting to be occupied?
It's a real mixed bag. You have some developers who get it, who are moving up the quality chain, who are building better quality products for more demanding and more discerning customers. You have others who are less market oriented, and it's going to take time for the excess inventory to work its way through. I think also that if you were an investor in China, one of the really interesting things to watch is going to be fire sales. And I don't think they're going to be necessarily well publicized, but there are going to be opportunities to buy properties at below replacement cost. And I think people who are positioned to do that, who understand the city, who understand the market, are going to do very, very well in the long term.
All right, well, you mentioned developers. We do have new housing starts this year at the lowest level since 2009. Is this a concern, or could be seen as a positive because it actually helps inventories get used up and therefore helps stabilize the market?
I see it very much as a positive thing. It's market feedback in action. With an economy as large as China's and with a population as large as China's, you're going to have people building things speculatively and in some respects building things blind. So it's really, really natural to have an overhang excess capacity, and clearing that excess capacity is a natural and very healthy market development that will ultimately benefit the housing market and people buying in the housing market.
All right, well, what about the developers? If housing starts are at the lowest level that they've been in 6 years, what does this mean for property developers? What are they doing? Are they branching out into other areas, commercial real estate, other businesses? What does it mean for them?
Yes, you're seeing that. Some of them are going overseas, building and investing in the United States and in places like Australia. Others are diversifying into other businesses, as you suggest. The thing to watch, though, is the people who are adjusting to the new market realities. And I think that's really what we're seeing here. Since 2014, the gold rush days are over. The low-hanging fruit has been picked, if you'll pardon the cliche. And now what you're seeing is the emergence of a more mature market, a more rational market, because frankly, you can't expect or sustain growth at 10+% every year. That's
Right.
simply unsustainable. So
Well,
a lower growth rate, but a healthier market is ultimately better for everybody.
Christopher, speaking of unsustainable growth, potentially in double-digit growth, we have certainly seen that in the Chinese stock markets. What impact has that had on the housing market? Keeping in mind, the Shanghai Composite is up 48% year to date. Are we seeing people taking some profit and buying homes in Tier 1 cities? Or are people who traditionally invested in housing now moving capital to the stock market as the regulations are being relaxed there?
You're seeing a little bit of both. Anecdotally, I have heard of people in Tier 1 cities taking profit and investing it in luxury property. But at the same time, you are seeing people who would have used property as a safe store of wealth, taking that and speculating in real estate. So it's having both a positive and a negative effect at the same time. Giving Chinese investors a range of places to invest their money, to park their money, and not just having it in real estate is also, I think, net a positive thing. It tends to avoid the hot money syndrome, where you get a lot of money rushing or stampeding into one market and creating, bubble conditions.